Yo, what's good? My name's Kang, and today I'm going to be talking about how you can invest into real estate with very little money through REITs. In this video, I'm going to be talking about what a REIT is, what are the pros and cons of REITs when compared to direct real estate, some REIT ETFs that you can look into, and at the end of the video, I'll give you my thoughts to wrap it up. But before we get started, could you do me a huge favor and hit that like and subscribe button? It really helps the channel grow. So, the housing market is booming right now, with the average price of a Canadian home selling for almost 40% more than last year. COVID coupled with low interest rates and the insane price of lumber are all reasons why the housing market is so crazy right now. And whether or not you think these prices are unsustainable, you might just want to get a piece of the action. But for a lot of young investors like myself, or even if you just live in the GTA, it's almost impossible to put down a down payment right now just because it's so high. Like, no sir, I do not have $200K to just throw down on a house. This is where I want to introduce REITs. A REIT, or a real estate investment trust, is a type of security that trades on the stock market just like a stock, ETF, or a bond. And a good way to think about them is if a mutual fund and a real estate had a baby. That analogy will make a lot more sense in a second. There are two types of REITs: equity REITs and mortgage REITs. Equity REITs work by pooling investor money and then giving it to a company. That company will then go out and purchase real estate and then lease it out to people in order to make money. What's cool is that these companies have to pay out 90% of their profits back to the investors in the form of a distribution, which if you think about it is kind of like rent. Now, this company will do all the work for you, like dealing with tenants, fixing up their property, or making sure that there's no meth labs being created in your basement. Equity REITs come in all shapes and sizes and give investors exposure to real estate markets that they weren't probably able to get to on their ones. For example, there are REITs for healthcare properties, malls, apartment buildings, office complexes, the list goes on. Mortgage REITs work essentially the same way, but instead of investing into physical real estate, they invest into mortgages or mortgage-backed securities or other related assets. And instead of generating money through rent, they generate money based off the interest on the loan that they give out. Mortgage REITs still have to pay out 90% of their profits back to the investor though, which is still cool. Similar to equity REITs, mortgage REITs have a whole entire array of markets that you can invest into, which covers different types of loans as well as different sectors across the world. Both mortgage REITs and equity REITs can be publicly listed, which means that they can go on a stock exchange like the TSX, or they can be privately listed, which basically means you have to know a guy in order to invest into them. So now that you understand what a REIT is, let me go through some of the pros and cons of owning a REIT versus owning direct real estate. Here are some of the pros. Liquidity. REITs are traded on the stock market just like a stock or an ETF would. You don't have to pay a realtor 2 or 3% in order to sell shares of your REITs. You just have to pay a brokerage fee, which usually is $5 to $10. Low barrier to entry. With the average home in the GTA being over $1 million, it's difficult for a lot of people to even put anything close down to 20%. Even if the prices in your area are significantly cheaper, it's still probably going to be a lot of your capital that you're tying down. By investing into a REIT, you don't have to tie up a significant portion of your net worth to get exposure to real estate. Diversification. By investing into a REIT, you're not only investing into one house, but you're investing into multiple homes. On top of that, you can even invest into different types of real estate like commercial buildings or healthcare properties that you probably wouldn't be able to have access to if you were only buying direct real estate. Simplicity. Purchasing a REIT is much more simple than finding a house in your area, hiring a realtor, contractors, lawyers in order to buy and then manage this house, and then on top of that, find and manage tenants. With REITs, you literally just log into your Questrade account and press buy. But there are some disadvantages to owning REITs when compared to direct real estate, which I'll go over right now. Leverage. REITs already have an inherent amount of leverage within them because these companies are taking out loans in order to buy properties, but it doesn't compare to the type of leverage that you get when you're purchasing your own home or purchasing a rental property. And I mean, sure, you could technically go buy a REIT on margin, but I really do not recommend doing that because you can get margin called at any point. But on the other hand, no one's going to come knocking on your door telling you have to sell your house because the value dropped by 20%. Tax. REITs pay back investors through distributions and not dividends, and there's a key distinction between them. Dividends are taxed much more favorably in Canada when comparison to distributions. When your distribution gets paid back to you, it's a combination of income and capital gains tax, which is going to be more than if you had just gotten a dividend payment. Now, all of this doesn't really matter if you're investing into a TFSA or your RRSP, but it's still something to take note of. On top of that, with a rental property, you're usually able to jump through a bunch of tax loopholes and hula hoops in order to reduce the amount of tax you pay on that property. Appreciation. By investing into real estate directly, not only do you get an income from the rent, but on top of that, you get the appreciation of the house as you pay down your mortgage. And that's not even considering some of the crazy market movements that could make your house go up like 40% or down 40%, I guess. And even though REIT prices can increase, I don't think it compares to the appreciation that you would get from a rental property, especially if you factor in leverage. Overall, I think it's difficult to compare REITs and direct real estate because they're almost completely different investments. Buying a REIT is like buying a stock and investing into a company, whereas purchasing a real estate property is almost like starting your own business. Okay, Kang, you got me convinced. I want to look at some REITs, but I don't really know where to start. Researching what REIT to buy is important. There are a lot of REITs out there that cover a bunch of different sectors and different types of real estate, so it's important to do your research and do your own due diligence. Not only do you have to look at what real estate markets you want to invest into, you also have to look at the management teams behind these companies. This may sound like a lot of work, but luckily for you, I have a solution. REIT ETFs. By investing into REITs through an ETF, you get a tiny slice of all these different companies without having to do the research behind the management team and the type of real estate investments that they're looking into. Here are 3 REITs that I recommend you take a look at. CRE is an ETF that covers the Canadian market, VNQ is an ETF that covers the US market, and VNQI is an ETF that covers international markets. I think a combination of these 3 would be a great addition to your portfolio if you're looking to expand into real estate. Overall though, I think that REITs are a great way for the average investor to gain exposure to real estate without having to throw down $200K. REITs have a low barrier to entry, are diversified, and make it very easy to gain exposure to real estate. Just a quick side note, I think a lot of people see, these YouTubers or even their friends that are investing to real estate and having rental properties and making a ton of money, and they're like, yeah, I just want to send it, just let me do it. But they don't see the amount of luck and skill or even the amount of hard work that goes into owning these rental properties and managing them. Like owning a rental property is essentially owning your own business and starting a second job. And for a lot of people, a second job is not what they want. They just want to invest into real estate. For those people who don't want to have a second job but still want to get exposure to real estate, I think REITs are a great option. On the other hand, most millionaires are made from investing into direct real estate. So it's hard to say that one option is better than the other when they're so vastly different. But other than that, thanks for watching the video if you made it this far. If you liked it, please consider liking, subscribing. I plan to make a new video every 2 weeks, so hit the bell notification so you don't miss out. If you have any questions or comments, feel free to leave them down below or hit me up on Instagram. But other than that, thanks for watching. I'll see you guys next time. Later.